Hello and welcome to interest.co.nz. I'm Gareth Vaughan with another of our double shot interviews, and I'm joined by Roger J. Kerr, who's a partner at PwC specialising in Treasury advice. Welcome in again, Roger. Good to see you.
Thanks, Gareth.
Look, we'll kick off with the US. Over the weekend, we've seen 10-year US Treasury bond yield, 2.28%, really low. Now, what's going on there?
I wish I could explain it because it's contrary to my view. We're expecting US long-term interest rates to move higher, through this period because of the stronger US economy, stronger growth, more likelihood of higher inflation. That would normally suggest that long-term bond yields move up. But certainly over recent months, we've had contradicting factors in the marketplace which are fairly hard to explain, and it's non-economic things that seem to be driving investors to the security and safety of US Treasury bonds, and just that weight of money has pushed the yields down. So it is the global geopolitical events, be it Islamic State in Syria and Iraq, be it Ebola, Ukraine and Russia. But, there's always crises and political tensions in the world. I don't think that's anything new, but just at this time, investors do seem to be very worried about those things. Plus, the other factor is in Europe, because they're heading towards deflation and maybe even recession again, and long-term bond yields in Europe have just gone lower and lower and lower, and for good reason. But it appears that the US have been dragged down because the US offers a better alternative, a better yield than the European bonds. So maybe there's been European buying of US Treasury bonds that have pushed those yields down to 2.28. With inflation probably running in the US higher than that at the moment, really hard to see how that can be sustainable, but that's where the market is.
Yeah, look, it's an interesting scenario. And of course, we've got the Federal Reserve, the next FOMC meeting coming up 29th of October. We're looking at perhaps an end to the quantitative easing, the money printing program that's been running for 5 years. Now, that in itself is going to be fascinating to watch. It's managing the exit from quantitative easing. Obviously, the Fed have got a few things to weigh up, the stronger dollar and the global economic picture and those other factors you mentioned there. And then the big question of, when and if they start raising interest rates from basically zero. What are your expectations on those fronts?
Well, I think the financial markets are giving us sort of two answers to that question at the moment. You'd have to say the currency markets, the US dollar has strengthened over the last few weeks in anticipation of rising US short-term interest rates in 2015. So the FX markets, in a way, have voted with their feet, and they always tend to price in the future 12 months ahead. So the FX markets are saying, yep, US short-term rates are going to be increasing sort of from mid-15 on. But the bond market is saying the opposite. And as if, the bond yields have got, as we're just talking about, bond yields have gone lower, and the bond market doesn't seem perturbed about US short-term interest rates moving up. So that is really odd. But I'd tend to back the FX markets and having this right. I think there's clearly, as we've just discussed, other forces in the bond market at the moment. But eventually, I think that will rectify itself. So I'd say the FX markets have got this one right. I mean, I think the US Fed the governors musing last week about, stronger US dollar is not good for the US economy. It makes US manufacturers less competitive in the world. I mean, I think the markets have exaggerated that comment or that risk that was foreseen, because, the US dollar, in terms of its materiality and impact on the US economy, import-export in the US is about 10% of their economy. In New Zealand, add together imports and exports, and it's 70% of our economy. So exchange rate, very important for the New Zealand economy. Doesn't really count in the US economy, the huge domestic economy. So I think the markets have overreacted to that comment about the US dollar being a stronger US dollar being a negative for the US economy. That's just not there. So obviously the domestic economy is doing real well. And the big question is, well, when will inflation move up in the US, and which is like wages moving up, house prices moving up. We haven't really seen the wages. We've got a stronger labour market in the US, but to date we haven't really seen the wages increase. I think that'll be the thing to look out for.
Any prediction on that?
Well, I think eventually they will. I mean, if labour becomes, and because the US economy is doing well, labour gets in shorter supply, of course there's going to be upward pressure on the price of labour. So eventually, it seems to be delayed, but eventually that will become, and it could be same in New Zealand actually as well. I mean, we can have fairly high non-tradable inflation, which is domestic prices, but yet no real signs of high wage increases in New Zealand, and that's one thing the Reserve Bank could be looking for in terms of their timing of returning to interest rate increases, because they're clearly on pause, and they'll be on pause to mid next year, probably about the same time as the Fed will be starting.
Now, your weekly column, you've talked about this flattening yield curve in the US. We're looking at the New Zealand yield curve. It's a really interesting scenario too. We were just talking off camera. I mean, if you look to 1 to 5 years, there's about a 49 basis point gap. You were saying 2 to 10 is only 44.
Yes.
Could we potentially be heading back to an inverted yield curve in New Zealand?
No, I don't think so. It depends on the timing of these, because it really, in the New Zealand, from 90-day interest rates right out to 10-year interest rates in the swap market, it's really two separate interest rate markets. I mean, from 3 years on, it's driven by the US, and up to 3 years, it's driven by New Zealand domestic inflation, Reserve Bank factors. So obviously the short-term rates, the 90-day rates, the OCR, they're not changing until March next year, or June next year. So they, and would US Treasury Bond still be down at 2.28 in March, June next year? I doubt it very much. So I don't think we're going to go to an inverse yield curve, but it's surprisingly flat. And normally a flat yield curve says, people don't see the inflation risks longer term. Long-term interest rates are down. Maybe the economy's slowing up. I wouldn't really say that's the case in New Zealand. I don't think the yield curve in the New Zealand context, because it's driven by two separate markets, sort of you can read into an economic outcome on that, as it's more about the US in the long run and us in the short term. And we won't be lifting again, as I said, until March, June next year.
Yeah, so that's the OCR review.
Yes.
We obviously have the next one October 30th, but you're expecting no change from 3.5% until March or June of next year?
Yeah, no, I think there is.
What are the key factors that
obviously,
Graham Wheeler has to weigh?
The key thing in the economy right at the moment is what impact will the much lower dairy prices and dairy farmer incomes have on the wider economy, and hence the demand in the economy. But at the end of the day, most of our inflation and inflationary pressures in New Zealand do not come from the demand side. I mean, okay, dairy farmers might be spending less money than they thought they were going to spend, and that would certainly have an impact in provincial New Zealand. But in terms of direct impact on the inflation rate, clearly it's going to be negative for GDP growth. That'll come off a bit. But in terms of the inflation rate, it always tends to be the supply side. And, I think there's enough activity in the New Zealand economy in terms of the domestic economy outside dairying to still have inflation, more likely to be 2.5% than 1.5%. Therefore, Reserve Bank will return to pushing the OCR up to return it to the new norm, which is 4.5%.
And the New Zealand dollar, obviously we had the Reserve Bank intervention, news of that recently. We had that interesting release from Graham Wheeler. Yes. With his explanations of why the dollar was overvalued. It's dropped below 80 US cents, around 78 this morning, about 90 Australian cents, TWI about 76.
Yes.
What's your outlook for the New Zealand dollar over the next few months?
Well, we don't see the Kiwi dollar against the US going back up too much. I mean, certainly not back above 80. I think the much lower dairy prices and a stronger US dollar are the two factors there. So that's been the change in recent months. So we did expect the Kiwi dollar to come down below 80 cents into this, about where we are now, 78. The big debate is, will we go, will that rapid fall we've had from 88 to 78 continue and go right down to the low 70s or even into the 60s? And of course the Prime Minister came out with his view of 65 cents, and I think really it's a hard ask to get to 65 cents. You'd have to have New Zealand interest rates being cut so New Zealand interest rates are no longer 4% above the rest of the world. That's unlikely. And you'd have to have dairy prices going even lower, clicking the bottom of the whole milk powder prices. Brave man that does that, but we've come down 50%. We're at 2,400 a tonne US dollars. At some point, they will stabilise, because obviously the buyers of protein, of milk powder, global food companies will say that's a cheap price. So at some point, once the overhang of supply in China is, worked through, we would expect some stabilisation in dairy prices, and that should be supportive of the Kiwi, as is the 4% interest rate gap over other currencies. So for those two reasons, even though we still see a stronger US dollar, we see those factors counteracting each other and holding us in the sort of mid to high 70s. So from 76 up to 80 is where we expect Kiwi dollar to trade. That's a 4 cent range. It never trades in a 4-cent range when the average range from high to low over the years is 9 cents. So it won't be that stable, but that's how we see it. We don't see it falling to the low 70s and into the 60s. There's a lot of people have been commenting on they expect that to happen now. We think there's enough with that interest rate difference to support it.
And just back on the interest rate subject, obviously we talked about what the yield curve's doing. What does this mean for mortgages in New Zealand at the moment? And what would be your advice or your pick?
Yeah, well, I think clearly, the risk has gone down in terms of floating rates going up or variable rate mortgages going up because the Reserve Bank are in pause, but they will go again higher next year. And you can debate by how much. Let's say another 0.5%. Just to 0.75% in terms of OCR increases. Depends how the economy does, of course. Depends what dairy prices do, all those sorts of things. But let's say that's likely. Therefore, with the swap rates coming down, pushed down by the US Treasury Bond yields coming down, again, it's going to be attractive for borrowers to fix and those sorts of levels, but not too much movement, actually. And I think the housing market has levelled off, and that's exactly what the Reserve Bank wanted to happen with higher mortgage rates and the LVRs, and I think they've done that pretty well.
Well, look, thanks a lot for that, Roger. That's Roger J. Kerr, who's a partner at PwC specialising in Treasury advice, and I'm Gareth Vaughan at interest.co.nz.